Have you ever wondered what happens to your money once you deposit it in the bank? An interesting question, isn't it? Well, the truth is, banks are not just vaults where your money sits idly. Quite the contrary. Think of your deposited money as an actor who just got a role in a play. The moment you hand over your funds to the bank, it's as if your money is given a script and steps onto a stage. But instead of a theater, this stage is the vast dynamic world of finance. Now you might be asking, what role does my money play? Your money, believe it or not, takes on the role of a catalyst, a spark that sets off a chain of financial activities. Banks use your deposits in a multitude of ways to generate income, turning your static savings into dynamic capital. The first stop in this journey often takes the form of loans. Your deposits provide the capital banks need to offer loans to other customers. These can be anything from small personal loans to huge mortgages. When these loans are repaid with interest, the bank makes a profit. Your money might also find its way into investment activities. Banks often invest in a wide range of financial instruments, from government bonds to corporate stocks. These investments over time yield returns that contribute to the bank's revenue. And let's not forget about the interbank market, where banks lend and borrow from each other. This is another theater where your money may play its part, helping banks balance their books while earning interest. But while your money is out there working, you can rest assured that it's not lost or at risk. Even as your deposits are used to fuel these various financial activities, they're still recorded in the bank's books. Whenever you need it, your money is there, ready for withdrawal. So the moment you deposit your money, it begins an interesting journey. It steps onto a stage and plays its part in the grand performance of finance, contributing to a system that keeps our economy running smoothly. Banks are not just safekeepers of your money, they are active participants in the economy. Now that might raise a few eyebrows among those who view banks as mere vaults where we stash our hard-earned cash. But let's delve a bit deeper. Banks, in essence, are the lifeblood of an economy. They play a pivotal role in the flow of money, from those who have it, the savers, to those who need it, the borrowers. Think of banks as the heart of the economy, pumping the blood of finance through the body of society. As you deposit your money in a bank, it doesn't just sit there gathering dust. Banks utilize these deposits to offer loans and credit to businesses and individuals. This is where the magic happens. Your deposited money, once idle, now fuels economic activities. It helps businesses expand, hire more people, and invest in new projects. It enables individuals to buy homes, cars, or even start their own businesses. Banks essentially act as intermediaries between depositors and borrowers. They attract deposits by offering interest and then lend out these deposits at higher interest rates. The difference between the interest earned on loans and the interest paid to depositors is one of the main ways banks make profits. Banks are, therefore, not just custodians of your money, but catalysts that transform your savings into productive capital. But that's not all. Banks also play a crucial role in the payment system. They facilitate transactions, allowing money to move smoothly from one account to another, from one part of the country to another, and even across borders. They provide infrastructure like ATMs, online banking, and mobile apps that make financial transactions convenient and efficient. In all these ways, banks contribute to economic growth and development. They help create a more dynamic, efficient, and inclusive financial system. They take the power of individual savings and amplify it, turning it into a force that drives the economy forward. Thus, your deposited money becomes a crucial part of the economic engine. Your deposited money doesn't sit idle. It becomes a part of a bigger financial process. So let's dive into the fascinating world of banking and unravel this process. You see, when you deposit your money in a bank, it doesn't just sit there. The bank puts your money to work. How? By creating loans. Now you might be wondering how your hard-earned savings end up as someone else's loan. Well, it's all thanks to a system known as fractional reserve banking. Under this system, banks are required to hold only a fraction of your deposits as reserves. The rest of your money, that's loaned out to other customers. For instance, if you deposit $100, the bank might keep $10 as a reserve and loan out the remaining $90. This doesn't mean that your money disappears. Quite the contrary, your $100 is still there, ready for you to withdraw whenever you want. But at the same time, $90 of it is also out there, being used by someone else. It's a bit like your money being in two places at once. Now, why would a bank do this? Well, it's simple. Banks make money by charging interest on the loans they provide, so when they loan out your deposits, they are essentially using your money to generate more money. But that's not all. The money that the bank loans out doesn't just disappear. It usually ends up back in the banking system, perhaps as a deposit in another bank. And this bank can then loan out a fraction of this deposit, creating even more loans. This cycle can continue, multiplying the amount of money in the economy. In essence, your deposited money doesn't just sit idle. It becomes a part of a complex financial cycle, helping to create loans, generate interest, and drive the economy. It's a vital cog in the great machine of finance. This is how your deposited money aids in creating loans for others. Now, how do banks profit from all this? You might be wondering. Well, the answer lies in the magic of interest. Yes, that's right, the interest that gets added to your loans and the tiny bit that trickles into your savings account. Let's start with the interest on loans. When banks create loans, they don't just hand out money and wait for borrowers to return the exact amount. No, they charge a little extra. This extra is known as interest. Think of it as the cost of borrowing money. Interest rates can vary widely based on a lot of factors, including the type of loan, the duration of the loan, and the creditworthiness of the borrower, among other things. Now, let's hop over to the other side of the banking business, your savings account. Banks also pay you interest on the money you deposit with them. This is their way of saying thank you for letting them use your money. But if you've ever compared the interest you earn on your savings with the interest you pay on your loans, you'll notice a stark difference. The interest you earn on your savings is typically much lower than the interest you pay on your loans. And here's the key. This difference in interest rates, this gap between what banks charge on loans and what they pay on deposits, is where banks make their money. This is known as the net interest margin. It's a simple yet elegant system. Banks serve as intermediaries, facilitating the flow of money from those who have it to those who need it, and they earn their keep in the process. So, the next time you see interest added to your loan or deposited into your savings account, remember that it's not just a number, it's part of a complex global system that keeps our economies running and our dreams within reach. This difference in interest rates is where banks make their profit. And that, folks, is the magic of banking. But what happens if things go wrong, you might ask? Well, let's delve into the risks involved and the safeguards in place to protect you, the depositor. Now, banking isn't without its risks. Banks, like any business, face the possibility of failure. This could occur due to poor management, economic downturns, or unforeseen circumstances. If a bank were to fail, it could potentially mean the loss of depositors' money. But don't worry, there are protections in place. Banks are heavily regulated to ensure they operate responsibly and maintain certain levels of capital to offset their risks. These regulations are enforced by various governing bodies, such as the Federal Reserve in the United States or the Prudential Regulation Authority in the United Kingdom. These bodies continually monitor banks to ensure they are operating within the set guidelines and maintaining the required capital reserves. In addition to regulations, depositors' money is also insured. In the United States, for example, the Federal Deposit Insurance Corporation, or FDIC, insures deposits up to $250,000 per depositor per bank. This means that even if a bank fails, depositors can recover their money up to the insured limit. Other countries have similar insurance schemes in place to protect depositors. It's also worth noting that banks typically diversify their loan portfolios. This means they lend to a variety of sectors and industries to spread their risk. If one sector faces difficulties, the impact on the bank is cushioned by its loans to other sectors. Furthermore, banks have robust risk management systems in place. They continually assess the risk of their loans and adjust their strategies as needed. They also set aside provisions for potential loan losses, further safeguarding depositors' money. Therefore, while your money is working hard in the banking system, it is also well protected. So rest assured, your money isn't just earning interest, it's also kept safe and secure.